In this video, we want to talk about market efficiency first, and then we'll incorporate a new branch of finance, if you will, which is a blending of psychology and finance topics called behavioral finance. So let's start with talking about what market efficiency is all about. Now, market efficiency follows or relies on, to a great extent, a foundation. And this foundation is what's referred to as the random walk hypothesis. And essentially, this is a theory that stock prices are largely unpredictable. So what does that mean? There have been studies done of price movements to indicate that price movements do not tend to move in neat, predictable patterns. So this random pattern, right, it's a natural outcome of the stock markets themselves, if they are highly efficient and if they respond quickly to new information. So what is an efficient market? That is a market that very rapidly and fully incorporates new information. So in other words, if good information comes to the public, that information is very quickly incorporated into a new price. And that new price won't change until there is another piece of information that is provided to the public. So in this section, we're basically going to talk about the theory, the efficient markets hypothesis. We'll talk about something referred to as market anomalies, that is, when prices don't seem to act in an efficient way. And then we'll also talk about maybe some explanations for why that happens. So the efficient market hypothesis, again, says that stock prices and the prices of other information rapidly incorporate new information. What this means is that if investors have this information, if the markets are efficient, and if the action or the reaction is very quick, then investors should not expect to earn abnormal returns consistently. Now, what does abnormal mean? Abnormal essentially means it's the excess of what you get over what the theory or what you expect to get. So you take the actual return minus the expected return, and that gives you the abnormal return. And for the formula of what you should expect, we use the capital asset pricing model that we've talked about in a risk and return chapter video that just shows the risk-adjusted expectations of purchasing a security. So if a stock has a beta of 1, the risk-free rate's 2, and the overall stock market return is 10, then the expected return is 10%. If the stock actually earned 12%, then the abnormal return would be equal to 2%. So again, another way of kind of asking this question is, can you consistently beat the stock market? The more information that's ultimately put into stock prices, and the quicker that happens, the more efficient we say the marketplace is. So again, just to kind of repeat, an efficient market is one where you use information, you cannot beat or achieve abnormal returns. And again, if we assume that normal returns are the stock market returns, this assumes that you cannot beat the stock market on average. Now, there are 3 different forms of this hypothesis that's based on information. So the weak form hypothesis basically says that past data on stock prices are of no use in predicting future stock price changes. Again, if we say if it is efficient, that means using past price data cannot help you to earn abnormal returns. Now notice I said abnormal returns. It doesn't mean you cannot make profit. It means that you cannot beat the stock market on average. And if an alternative investment is just a stock index mutual fund, why would you invest and spend money on something that you spend time, money, research, resources, when you can buy something and actually earn a higher rate of return? So the idea here with the weak form is, stock prices are going to move at a random clip. Whatever price you get, it just happens. There's no rhyme or reason as to why it happens. So if the weak form hypothesis is true, if you cannot beat the stock market using past data, the best strategy to use would be to purchase a diversified portfolio and just hold it. Now, the semi-strong form basically says that investors cannot use publicly available information. So what information is publicly available? Well, anything that is past information, that is the weak form hypothesis, and all the current events that you can think of, all of those things are this public information. So using that information, if the market is hypothesis, you cannot use that information to, again, earn abnormal rates of return. So what does this mean? Well, it says that you should be able to get a current event and earn a return greater than the stock market on average. So what we find, though, is that unlike the weak form, there are what we refer to as price anomalies. There's things in the market that just happen that we can't explain, right? The information is known, it is public information, but using that public information, there is a way to make money and earn excess returns. The third form is called the strong form, and the strong form says there's no information, public or private, that allows investors to consistently earn abnormally high returns. One of the scenarios here basically says if you have inside information, right? You happen to know the company is going to do something and it is great. And if you trade on that information before anybody else in the world trades on it, you won't be able to beat the stock market. And on its face, that just doesn't make sense, right? So using public information, sometimes you might be able to earn a higher return, most of the time you won't. But using private information, you should always be able to beat the stock market. So what does this look like in real life? Basically here, we're showing some daily stock price reactions to positive earnings news. And if you kind of think about this, there's no information, so there's no abnormal returns earned. The information is provided on day one and at time 0, and by the end of day 1, there is this spike. The new information was positive. The new price moved to this high range. Now, in reality, if this was a perfectly efficient market, day 2, it would already be back down here to the abnormal returns. So what this tells us is, even though the market reacts very quickly, there is an extra day here where you can earn some abnormal returns before it gets back to, again, the average over time. So that is a picture of a market, what they refer to as being not strictly efficient. It's close, but it's not perfectly efficient. So arbitrage is a type of transaction in which the investor buys and sells the same asset at the exact same time at different prices to earn instant risk-free profit. Essentially, you're not spending any of your own money, but you're making money. So now in the real world, if price differences exist, arbitrageurs are going to exploit those differences. They're going to trade away any pricing advantages. So depending on how efficient the market is, arbitrageurs can be more or less successful. If the market is not very efficient, then there's time for arbitrageurs to get in and make substantial returns. If it's very efficient, there's not enough time for all the arbitrageurs to all make money. One or two will make some money, but most of the rest won't, because the pricing will immediately or very quickly reflect the new value of the asset. So moving on now, talking about times when this efficient market hypothesis just doesn't seem to hold. These are what's referred to as being market anomalies. They're inconsistent with the efficient market hypothesis. One of these is something called the calendar effect. In particular, it's the January effect. And in this case, it says, especially with small cap stocks, they seem to outperform other stocks, but they outperform it in January. So January is the month, on average, that the stock market makes all of its money. So a strategy might be to buy stocks December 31 and sell stocks January 31. That way you've owned stocks for the month in which stocks are going to earn the greatest rate of return. For the other 11 months, put your money in a money market account and just let it ride, because it's not going to earn any extra returns during that time frame. There's something called the small firm effect. Small firms tend to add positive abnormal returns, sometimes as much as 5 or 6%. So why does this happen? Well, small firms might offer higher returns just because of risk. But some studies have shown that even if you adjust for risk, there still is some abnormal returns that can be gained by investing in small firms relative to large firms. There is a market anomaly that's referred to as the post-earnings announcement drift. So if good information is given to the public, we expect the price to rise, but again, it should stay there until another piece of information then changes the level of price. Well, what the announcement drift or momentum structure talks about, or anomaly talks about, is that there is some carryover of this effect. So if you kind of look at this next picture, you see that up until time zero, there's very little abnormal return made. And then a good announcement is made, the price rises, but there is also then some continuing price drift upward. And likewise with it negative. The price-wise, the negative returns continue down for several days, as many as 52 weeks. For a whole year, it's going to be changing. So again, nobody understands how this happens or why it happens. We just know that this is something that we know occurs in the public. The value effect has to do with the PE ratio or the market to book ratios. If you use these ratios to buy stocks, you need to understand how the anomaly works. On average, low PE ratio companies or low market to book ratio stocks outperform high PE ratios. So if you want to invest and have an opportunity to earn more, you need to concentrate on those stocks, those investments that have relatively low PE and low market to book ratio stocks. So can you make money by buying high PE stocks? Absolutely. But the market anomaly says you can earn extra returns by looking at these lower PE stocks. So what are the explanations, right? So stocks appear to earn some abnormally high returns, typically are probably riskier than other stocks. So this merely is just a compensation for risk. Some anomalies may just be patterns in the data that are just by chance. That is, it is a random event. We just can't we just can't see the connection between what's causing this and the actual event. And behavioral finance basically says, look, market participants make mistakes when they invest. And these mistakes can create some persistent inefficiencies in the market, right? People drive the demand curve for stocks. We create the price. The supply of stocks is provided by the company. But the demand that's driven by investor desires, that's what ultimately creates the price. And frequently we make mistakes. This is what behavioral finance attempts to show us or explain. The mistakes that people make. Why do we make them? And how do they ultimately impact the returns of the company? Talk to you soon.